Hello guys, welcome to the show. Listen, I'm really glad to have you here. Now, topic of our show tonight is we're going to discuss why the crash did not come in April. The crash of the stock market. Getting straight to it, we're going to open up the charts and we're going to show you the reasons. Okay, so first off, what we're looking at here is we're looking at the 1 year of the US 10-year. 1 year chart of the US 10-year right here. And right here, what we see is in around October, when they first started their quantitative tightening, you can see the bond yields, they went up a little bit, and then they eased along here, and they started to slowly go up as they increased their quantitative tightening. Now, at the end of the year, they really started a steep incline right in here. Very steep incline. And this was because at the end of the year, they increased the amount from 10 billion to 20 billion. And that increased the amount up to this peak right here. Now, what happened is the stock market. Let's swing the chart over and take a look at the stock market now. Right? And what we're looking at here is we're looking at this peak right here was on the first month, 26th day. Right? What happened is it shocked the Fed. The Fed was going through with their quantitative tightening, and everything was grand, and the stock market was actually still going up during their quantitative tightening. Because right here, we're into January, and they've already increased to 20 billion, and everything was just rosy, and the stock market was going up and up and up to this peak. And the Fed was like just cheering, we've done it, we're successful at our quantitative tightening, and we're actually being able to successfully sell our toxic balance book, and everything's fine, and they were great and rosy until all of a sudden the stock market did this. And then it did this, all the way down to this bottom here, right? On the second month, around the 8th day. This shocked the Fed, right? And so what happened was they had to actually use their different tricks, probably their different funds that they use to prop up the stock market. They did backdoor, whatever. And they propped it up. And what happened is it was going up really good, right? Until it hit this spot right here, and then it started to fall again. And when they seen it started to fall again, so this spot right here was in the second month, around the 16th day. They could see that the stock market, or the second month, say around the 21st day, right here, it was falling. And they'd seen it had been falling for a couple days, actually 3 or 4 days, right here, right on that spot, right there. That's the second month, the 21st day, right there. Now take note of that day, the second month, the 21st day, right there. Because why this shocked them is the initial fall, and then they used their special backdoor whatever to bring it up a little bit. They probably bought stocks directly and injected a tremendous amount of money, and they were able to bring it up a little bit. Basically, they're cheating, the Fed. But then it started to fall anyway. And when it hit this valley right here, they said to themselves, if we don't do something right now, we're in for a crash. And so this was the second month, the 21st day. Now let's switch back over to the bond market, right? What do we see here? Second month, 21st day. You see this little peak right here in the bond market, the bond prices? Okay, second month, 21st day. Right there, that peak. Now let's switch back over to the stock market again. Second month, 21st day, right there. Right? Now, why is that so significant? Well, look at the drop-off in the stock market. That shocked them. Then they did their special, they used their special tools to bring the stock market up again, and they thought they had it contained, and they were probably still using that money, that special tool, and it started to drop anyway. Went right down to this point right here, and they said, we got to do something, guys, or she's going to go right down. She's just going to fall right off right here, right now. We're going to lose her. And what they did? What did they do? Well, look right here. Let's go back over to the bond market again. And what did they do? Right there is where they did it. Now, let's move back forward in the bond market, forward in time a little bit, and take a look at the effects of what they did. Right here on this peak. We see this downward slide right along in here in the bond market. They cheated. They were buying bonds through this time right here. And they actually brought it down to this point right here on the 3rd, 29th, 2018, right in around there. They brought it down to a low of, let's see, what was the low? Let's open the chart up a little bit wider. The low was 2.72, I think. No, 2.71. They brought it right down to about 2.71. So they brought it from 2.96 or 2.95 down to 2.71 with their cheating. This right here, this date right here is when they stopped their cheating. And what started to happen again? The bonds now are on this trajectory right here, going back up again right now. So their cheating brought it down to here, and now the bonds are booming back up again because they've went back to their quantitative tightening. So it was a cheat that they did. They probably bought bonds themselves. Plus, you have to understand that there was probably a number of people that were coming into the market to buy bonds because bond yields were high. So the combination of the two things together, probably them cheating and monetizing the debt themselves, and buyers coming into the bond market, brought them bond yields down to 2.71. That took the pressure off of the stock market. Now, if we come back over here, we can see what happened. Let's come back over to the stock market here. We can see it right here in this spot right here where they took the pressure off. The stock market went all the way up to 25,709 after that when they were buying bonds. And it didn't really want to drop off. It was kind of like going along level along in here. Basically, if you drew a line level, you'd find that the line in the stock market was about 24,800, right? It was going along level. But now they went back to their quantitative tightening again. And what's happened? Right around this spot right here to here, the market's starting to fall off again. It's starting to fall off a cliff because they're back at their quantitative tightening again, and bond yields now have risen over 3%. They're going to stay with their quantitative tightening. They're going to stay the line. They really want to do this quantitative tightening, and they don't want to completely back off the pedal forever. They don't mind cheating a little bit. It's almost like a person that's on a diet. He doesn't mind having that piece of cake once in a while, but he's, for the most part, he really wants to succeed on his diet. And that's what the Fed is like right now. They really want to succeed on their diet. So I believe that they are going to continue with this. Now, according to their plan, it was $10 billion a month until the 1st of January. In the first quarter, January, February, March, $20 billion. Then $30 billion, March, April, and May. The 1st of June, they're raising it to 40. The 1st of June. Right? When they raise it to 40, that extra $10 billion coming in again, more, you're going to see the bond yields start to move even faster to the upside. Now, I've stated it before, and I've stated it quite a few times. When the bond yields hit, the 10-year hits 3.25%, that's the mark I'm looking for the market to really start to roll over and fall. There's a second mark that we're looking for here, is when the market goes down below 20,000. There's going to be a change that's going to take place when the market goes below 20,000. What the change is going to be is they are going to switch over from cryptocurrencies, from wanting cryptocurrencies, to wanting physical metals. There's a change going to happen. Right now, they don't want physical metals. Everybody's into cryptocurrency, and the cryptocurrency's all the rage, and they're thinking it's going to go to $100,000 a Bitcoin, all this kind of stuff. And they're still holding the price up. And even when the market falls a little bit more, I think there's going to be even more incentive that they're going to want to buy it, the cryptocurrencies. But when the market goes below 20,000, a change in psychology is going to occur. in the minds of investors. Fear. Massive fear is going to enter in then, because they're going to realize this is not a correction, that we're in a crash. And they're not going to know when the crash is going to stop. They're going to be like, how far is this going to go? It's down to 20,000 and it's dropping by the day. We're in a bear market. And they're going to suddenly, it's going to dawn on them, hey, you know what? We're in a bear market now. These are not corrections. We're not buying the dip anymore. You know, the whole thing, the whole psychology is going to change. And then what's going to happen is fear is going to enter in, tremendous fear, because they're going to realize just how far we've extended credit in this system. And it's very likely that certain banking systems then are going to start to roll over. There's going to start to be troubles starting to form, because the stock market will have fell so far at that point that it's going to start to expose. It's almost like when the tide goes out, who's got clothes on and who doesn't. It's going to start to expose the financial system for the fraud that it is. At that point, fear is going to enter into the market, and people are going to want to be holding real tangible assets, real tangible liquidity. They consider fiat currency tangible liquidity, and they're going to go into fiat, and they're also going to go into gold and silver at that point. Both. And there's going to be those three assets are going to go up, and they're going to sell everything else. They're going to sell their classic paintings. They're going to sell their classic cars. They're going to sell the real estate. They're going to sell off the Bitcoin. They're going to sell off everything else that they have. There's basically, we could actually be looking at margin calls, like margin calls, but mark to market. They can say that mark to market doesn't function that way. They can write down all the rules that they want, but like I said in that episode I did not long ago, when push comes to shove, it's like, pay me. We want it now. We don't care that there's no buyers. We want our money, and we want it now. Market to market, and it's going to tear the system to pieces. We're going to find out what everything's really worth when there's no buyers. Quite seriously. And when everything's going up for sale simultaneously, and everybody is rushing into fiat, basically, fiat or gold and silver, those three items will be going up massively, and you're looking at deflation. You're looking at a massive episode of deflation that's going to be hard to control, but they're going to have to, because this is going to be a massive crisis. A massive crisis is coming when this market finally rolls over. And this crisis is going to come so fast, it's going to freeze up the banking system. You're not going to be able to get cash anywhere out of the system. And so one of the problems with this is, even though the great liquidation is occurring and everybody's trying to get into cash, if the cash is actually in the system, it's going to be frozen. And this is even going to make real cash even rarer, because physical cash is going to be, it's like physical gold and physical silver that you'll actually hold in your hand is going to suddenly have a great value for a little while. For a little while. Because when the government reacts to this, and they're going to absolutely have to react, they don't have any choice. If they don't react, they are going to be in big trouble. And they don't want to be in big trouble. They want to be the heroes. They don't want to basically have what happened in France a long time ago happen again. They don't want that. That's what would happen. The same thing has happened in France a long time ago. They don't want that. They're smart enough to know where their bread is buttered. And they are going to want to be the heroes. And there's only one way they can be the heroes. They got to print us out of this mess. Then they can be the heroes. They can save the day. But in doing so, they're going to destroy the fiat currencies. And this is what's going to become the driver of the cryptocurrencies. So getting down to the basics of why this market didn't roll over in April was the Fed cheated. They right here on this spot right there. That's the exact spot where they cheated, because that's where they saw the market was going to roll over again. Right there. The market started to roll over. It went right down to there, and they then started buying bonds like crazy. And you can see it. It's the date was that date right there where I got my X right there is the 2nd, the 21st. Let's go over to the bond market. Right there, 2nd, 21st, 2018. And look, the bond prices the bond yield started to fall again, right there at that point. And that's where the market was rolling over. And so you can see exactly what they did. They caused it the stock market not to fall. We were in for a crash right there. Right there. But they've only delayed it. That's all they've done. They've delayed the crash because now they're back up to their old thing of trying to go up, and they're going to have to increase now to $40 billion a month very soon, and they're probably coming around for another interest rate hike. All of it comes together, and it all points toward rolling the market over and creating this deflation. It is possible. I don't really like to say this, but it is possible that gold and silver, even when the market goes below 20,000, that it won't take off skywards that fast, because there's going to be so much fear that really where they're going to want to be is in dollars at that point in time. But you got to understand that if you wait that out and try to get the lowest price on the gold and silver, you won't get any physical. Because when the deflation actually hits, first thing is so many people are probably going to run to it. It's probably going to create a separation between the physical price and the spot price. And what happens then is that's called a premium. And so if you want physical at that point, you have to pay a premium, and you probably end up paying as much premium as the price is right now to buy it. And at least if you buy it now, you know what you got it in your hand. Right? If you wait until the price goes down to $12 an ounce, but there's a $6 premium or $7 premium, I mean, you're right back, pretty much back to where you started. You know what I mean? But then once the Fed comes in to fix this problem, you just ain't going to get any gold or silver. It's going to be no bid on the stuff. It's going to be it's going to all be held in the hands of strong hands that aren't going to sell the physical anymore. You're not going to be able to get any. So this is what we got coming down the pike. We got a market crash coming. The Fed is going to determine when the market crash actually occurs because they control the markets now. They're going to increase to 40 billion. That's probably going to roll the market over some. Will it cause the crash? I'm not exactly sure, but they're going to roll it over. They're going to do that June. And then in September, they're going to raise it to 50 billion. See, they just keep raising the bar. They're going to bring this crash if they keep raising the bar. It's possible that they might be looking for some sort of a soft landing where the stock market continues to fall and fall and fall, but it's not a sudden crash. Maybe they're looking for some sort of a slow burn crash where it takes 6 months or something for the stock market to go down 40%, to drop off 40%. But that's what we're looking at, really. We're looking at 12,000 on the Dow, you know, maybe 14,000. But 40-50% drop off in the stock market. So listen, thank you guys for listening. Like and subscribe, and we'll catch you in the next show. Bye.